Academics love to remind us that in a market that is functioning efficiently, there is no possibility of a portfolio manager or an investor persistently being able to beat the market. And yet, most fund managers will describe themselves as being above average and able to beat the market on a regular basis. And one of the reasons they've been able to get away with that in the past has been the lack of standard and standardized performance reporting systems. Today's session, we're going to take a look at performance reporting, and in particular, we're going to start off by looking at some of the basics of portfolio risk and return measurement. We'll take a look at the global investment performance standards that are promoted by the CFA Association, and we'll talk about some of the specific metrics, including the Sharpe Ratio, Sortino Ratio, Treynor Ratio, Jensen's Alpha, and the Information Ratio. These are alternative measures. They're computed very differently and in response to different kinds of pressures that are put on fund reporting management. We'll also compare those at the end of today's session. First off, just a general introduction to the concept of a portfolio. I know we've already looked at that, and we talked about the benefits of diversification and correlation. And we did that in a previous session, so we're not really going to talk about that today. Essentially, we define portfolios as groups of assets, stocks, bonds, other types of asset classes that are held by our investor. And we can compare these by taking a look at them in groups and weight them according to their presence in the portfolio. The portfolio weights then are going to be a big part of our unit of account for this session. They're typically described as being a percentage, of course, with all of the sum of the weights equaling 100%. Now, the expected returns are calculated on the basis of each of those different classes or types of assets. Our expected return for a portfolio made up of n classes of assets or n particular assets. If we have 10 assets, n becomes 10, for example, will equal the sum of all of the different weights times the expected return for each particular investment or asset class. Very simple calculation. The calculation of the variance, or of the volatility, of the uncertainty of the portfolio, is always a little bit more complicated. As with looking at returns for individual stocks, the variance isn't just the simple weighted average of all of the different sources of uncertainty. And in this particular case, we've decided that we're going to treat the uncertainty according to the different types of states or possible outcomes. So if we have got a probability of a particular state or outcome, that's P sub S in the measure of our variance. And then we're going to multiply the probability times our observation of the expected return in that particular state. So if we're thinking about recession or boom or perhaps an average economy, a hyperinflationary economy, those would be alternative states. And in each of those states, we can predict there'll be a certain level of return. Perhaps bonds will outperform in one state and equities in another. And we'll compare that to the expected return of the overall portfolio. Of course, we square that to be able to get rid of the signs, and then we just consider the difference. So we multiply the probability times the expected premium that we're going to receive in each of those markets. And that provides us with a measure of the variance. And of course, we can take the square root of that to get the standard deviation. And that standard deviation will be the measure of the portfolio uncertainty. I mentioned earlier that we use the CFA programs, Global Investment Performance Standards. And this is because we know that comparing investments across different classes of assets, across different markets, and between different hedge fund managers, perhaps, or between different mutual fund managers, can be very different, very difficult. And different systems will produce different rankings. So obviously every fund manager is going to choose the system that ranks them the highest when they're going to report their results. CFA basically said stop it. They said you're going to have to use one standardized method for all forms of reporting. And that produced their GIPS standards. Essentially, The goal of this is to provide a consistent method to report performance to actual clients, but also to prospective clients, so that we're not providing misleading advertising. And essentially, firms are not required by law to adopt the GIPS. In fact, of all of the largest investment banks, at least one of them has not signed on to GIPS. And across different markets, there may be different pressures from regulators to do things a little bit differently, although I believe that most of the most important major markets have chosen to adopt GIPS. And you can get more information about this by looking at the CFA's website and the GIPS standards, a regular reporting feature on the CFA website. Now, GIPS does have in common that it says, well, you can use a variety of different measures. And so whether you're using the GIPS official standards or prospective standards, measures like the Sharpe Ratio are regularly featured. The Sharpe Ratio is named after and created by William Sharpe, who won the Nobel Prize in 1991, partly because of his work on the efficient market hypothesis, which developed into CAPM, and also because of the promotion of the Sharpe Ratio, which has become pretty much a basic standard that's used everywhere. Essentially, it's a risk-to-reward ratio that essentially says we're going to compare your returns above the market rate of return. We're going to compare that to the total amount of risk that's in the market. So in the numerator of the Sharpe Ratio, we have the return to the actual portfolio minus some standard measure of risk-free return or average return. And we're going to divide that by the standard deviation for the portfolio. And the higher the standard deviation, the less impressive this abnormal return is going to look. The numerator is essentially an abnormal return, a surplus return, sometimes called surplus profit, although you'll never hear an investment banker calling that. So essentially, the numerator says this is how much return we made in excess of a fair rate of return, and this is how much risk that we took in order to get it. So it standardizes abnormal returns for risk. Now, this caused a lot of discussion among other academics and other investment bankers, and they said, well, we like the idea of a risk-weighted measure of return, but all risk isn't bad. In fact, we kind of like the standard deviation that comes on the upside. And for that reason, we ended up with something called the Sortino ratio, promoted by Frank Sortino, who said, we've got an alternative that only uses the risk that happens on the downside. In other words, the upside volatility is good. We like that. When we have good days, we like those. We don't count those as risk. We only count bad days as being risk, a one-sided or one-tailed version of risk. This ratio is designed to penalize, then, investment managers who take on risks that create more downside possibilities and promotes investments that provide more upside volatility. It works just like the Sharpe ratio, the calculation does. It has the risk premium in the denominator, and the risk or the alpha, the abnormal returns in the numerator. Unlike the Sharpe ratio, it doesn't use standard deviation in the normal sense. It uses the standard deviation calculated by only looking at that downside deviation or the negative deviation. Essentially, if you think about a standard normal distribution, if we're expecting to receive the mean rate of return from an investment, volatility, standard deviation, is calculated on the basis of both the left and the right tail. However, we know that everything to the right of our expected rate of return is a good volatility. We're only really concerned about the downside volatility. In fact, we know that in some investments that there is not really going to be a normal distribution, that some distributions are skewed, they have particularly fat tails or kurtosis. And also, we may actually be satisfied with a minimum level of return that is slightly below the mean. You can see that in this particular distribution on the right-hand side, the desired target return is actually below the mean rate of return, so we're only really concerned about the true downside deviation. The return that's less than a particular threshold. The calculation essentially says that we're not going to penalize the manager for upside volatility, and we're going to separate harmful downside volatility from average volatility. It does create problems in calculation because it means we're going to throw out a lot of our data. And essentially, the ratio itself looks just like this. We have got the rate of return to the portfolio minus some kind of a threshold value, that value H. It can be an arbitrary number that's been chosen by the fund manager, or it can be based on a particular historical experience. The key difference, though, is here in the denominator, where we have the standard deviation. So we've got our sigma theta for the portfolio, and sigma theta is the downside deviation, not just the standard deviation. You can see in the calculation, it looks a little bit different. It still compares the observed return for a particular period, for every period, to the expected return, but it says we're going to only consider the minimum of a positive standard deviation or 0. And again, we square that and use the number of those observations, only the actual observations of the negative returns. Perhaps an example helps to clarify. This spreadsheet is one that I provide to class, and essentially says, take a look at 12 months experience. Over these 12 months, our returns were quite variable. In a good month, we have 0.89, 2%, 3%, 1%. Those are positive returns. And in a bad month, we can have negative returns of minus 0.2, or just about minus 1, I guess, is probably the worst of our experiences. A good month, when we significantly outperform our expectations and make 1 or 2% positive returns, we don't care. Those are good experiences, and we're only concerned about measuring the bad experiences. We've also said that on a monthly basis, the minimum acceptable return is 0.4% per month. That's something that we've input. That's our threshold, that value, the H that we're looking at. So the excess return is essentially taken as the observed return minus 0.4, the minimum acceptable return, gives us 0.49. That's how we got that 0.49 number. Since that number is greater than 0, we just enter a 0 because we don't care. It's not going to be part of our bad experiences. The next month, we ended up with a return of 0.12. We subtract 0.4 from that. That gives us a negative excess return of 0.28. Of course, that's a bad outcome, so we record that, 0.28. And so on for each of these months. In months where we have a positive outcome, we record zeros, and months where we have a negative outcome, we actually report the negative outcome. To calculate the downside risk, then, we're going to use the sum of the square of the differences. So we're going to square those negative excess returns, and then we're going to take the sum of those, and then we take the square root in order to get the downside risk. So that becomes our sigma theta that we were looking at in that earlier version. The average excess return, then, is just the sum of those excess returns. The alpha, the excess returns from column C, we just take the sum of those, and that gives us, sum of those divided by 12 rather, and that gives us the 0.31 as our average excess return. Dividing the average excess return by the sigma theta, by the downside risk, gives us a Sortino ratio of 0.611. By itself, that doesn't tell us a lot, but it will help us to compare between other portfolios that have also been computed using the same method. And it's a positive number, so that means that we've managed to create some kind of alpha, some kind of return in excess of normal return. You can see there's a second version of this called the Sortino Ratio VBA, and that's been calculated in a spreadsheet using a downloaded Sortino ratio that is essentially based on the model that we just saw, and it's available at investexcel.net, kind of a wiki source for finance ratios. Now, competing with the Sharpe and the Sortino ratio, we have the Treynor ratio. And in this case, Jack Treynor, also a highly esteemed academic and investment manager, produced an alternative version, which is essentially another return to volatility or reward to volatility ratio. It measures how much excess return was generated for each unit of risk taken by the portfolio. That's why we have the beta for the portfolio in the denominator. That's how it's different from the Sharpe ratio. Now, you can calculate, or we've seen the calculation of the beta using a spreadsheet, and in this particular case, we have got a spreadsheet that has been calculated using the downloaded information for a stock and its index. So we have British Petroleum, BP, and the Financial Times All Shares Index. So we've downloaded the monthly prices. This table does go on for a lot more rows. It tells us that we have calculated we can calculate the returns to the stock and the returns to the index for each of those 60 months. You can see on the chart on the right hand side of the spreadsheet that we've plotted each of those monthly outcomes, and we have the market return on the x-axis and the company's return on the y-axis, and putting a plot line through those, a characteristic line, tells us that the slope of that line is our beta of 0.29. The mean return is calculated by taking the return to the stock and taking the sum of all of that information that is calculated, in this case, in column E. Those are the returns to BP. And our mean return, 60 months worth of information, each individual one summed up and then divided by 60. Less 1 because you can only measure the differences and not the actual results. So we have 59 data points that are being used in that particular case. The risk-free rate was used as our threshold in this particular case, so the actual return minus the risk-free rate for each period. And we take the return minus the risk-free rate divided by the beta, and that gives us a Treynor ratio of, well, 0.000 or 0.6%, almost 0.1% or almost 1%. So that becomes our, again, positive measure of the Treynor ratio. Something in common with all of our measures is that we want to measure abnormal returns. How much better did we do than the alternative portfolio? This was actually produced or promoted by Michael Jensen, and it was the first time that anybody made a substantial effort to measure performance for portfolio managers in any kind of a standard way. It goes back to about 1968. Michael Jensen, who is probably better known for the work that he did in agency theory, and had this particular model named after him. Although we'd say economists have been measuring things like surplus profit, accountants have been measuring abnormal earnings just as long as we've been keeping track of numbers. Essentially, the alpha is the excess return above or below, if it's a negative number, the security market line. It's interpreted as a measure of how much the portfolio beat or lost out to the market. We compute it as the portfolio return less the expected portfolio return as predicted by the capital asset pricing model. And of course, you recognize the part that's underlined in purple as simply CAPM, the risk-free rate plus the idiosyncratic risk for the firm, beta times the market premium. And we can say that actual premium is observed, so as long as the observed was greater than the cost of equity as measured by CAPM, we've produced alpha. Of course, alpha becomes the most desirable thing in investments. That's why we have websites like Seeking Alpha, and we talk about chasing alpha as a main objective of investors. So positive alpha means you beat the market, and that's definitely going to be a good thing. You can see on this chart the security market line, or the characteristic line, essentially is the line that risks the risk-free rate with every possible combination of return and risk. return on the vertical axis, and risk as identified by beta across the horizontal. So if we're at a point like beta B, and we're producing return B, we're right on the security market line, and so we're producing 0 alpha. That's our 0 alpha state, because the rate of return minus the CAPM indicated return are exactly the same. There's no abnormal earnings, there's no alpha. If you're at a position like, well, beta C, and our return was, well, return to C, and it's below the security market line, we've created negative alpha, because the cost of producing, the cost of equity, would be on the line, and we've only made R sub C, so R sub C minus that amount on the curve is a negative number, and we've destroyed investor wealth. We've underperformed. And of course, for A, we have a beta that is at a point like this one that's indicated right now on the chart. Our actual return was R sub A. R sub A minus the indicated CAPM value for that particular level gives us a positive alpha, so we like that one, it's positive. Now, you recognize this, of course, as a type of regression line, and whenever we're using regression, we do tend to talk about alpha as being the intercept on the y-axis. If that's the case, that means that alpha must be that constant that is used. And so we can actually solve for that constant and use that as an alternative approach. So our characteristic line, as described originally, was expected return to a portfolio minus a risk-free rate is equal to the information that we have from beta. And just by rearranging that, we can say that the expected rate of return in this particular state to our portfolio is equal to, well, the expected market premium times beta. And beta then becomes that important X value. So with only slight modification to the characteristic line, we can produce an alternative perspective of this. If we know that we expect that we're going to receive a 2% regular premium or regular alpha, then we can replot the entire line, this hypothetical line, so the slope is still the same as it would have been if we had had used the original CAPM model, but since it intercepts with 2, the intercept value is the alpha. We can estimate the alpha using regression and using a regression model, and we'll show you how to do that with a spreadsheet. If this is getting a little bit complicated, don't worry. It is pretty much the standard view that we have of how regression works. And by reviewing regression, we can understand the alpha and the beta in this case. Now, in this case, we want to know what the alpha is, and we have the other information. We want to know whether or not the returns are consistently higher or lower than the market, and so we apply linear regression to this. The intercept value is the excess return of the market. The y is the excess return of the investment. So the intercept of this equation becomes the fund's alpha. We'll show you a spreadsheet in just a second, and you'll see in this that the intercept estimate is minus 0.0161, or 1.67% negative alpha. The beta is 0.96, and that of course is the standard beta that we use for this value. And if we take a look at this particular version, this particular spreadsheet, and the information that we've got, we only have 5 data points, annual data points over 5 years. We have return to our security of 10%, minus 8, minus 4, minus 40, and 12, and we have a return to the corresponding stock market, 8, minus 12, and so on. We've been told the risk-free rate for each of these years was 3%, 2%, 4%, and so on. So to do our calculation, we just take a look at the change from one period to another. And so we see that the security rate of return, the rate of return that we observed, 10% minus 3% gives us 7% rate of return for the security. For the market, 8% rate of return minus 3% gave us 5% return for the market. we do that for each of these periods. So we can plot that now on that XY axis. We can plot the returns for each of those two markets, run a regression, or just use the regression function in Excel, and we see that the key bits of information, x variable 1, our beta, is 0.96, and that the intercept, the y-intercept, is 0.0167, let's say, or 1.67%, and it's a negative value. And that essentially tells us what we just saw on that previous chart. We saw that line that was coming out of the origin below zero value with a slope of 0.96. We'll come back to that particular example in just a minute, and we'll see how that works with something called the information ratio. The information ratio then is the next of these performance metrics, and it's one of the most standard ways that we can compare different types of portfolio performance. Several different fund managers all working in the same market. The one with the best information ratio is the one who's most capable of applying information that may not be publicly available. The one with the inside information, perhaps. We know, or at least we believe, that funds alpha is statistically significantly different from zero. Or is this just random chance, random luck? To calculate this, we evaluate the significance of the alpha estimate using a regression, or an alternative, calculate the fund's information ratio. The ratio itself is simply the fund's alpha divided by something we describe as tracking error. Tracking error measures the volatility of the fund return relative to the benchmark. In other words, if the fund perfectly tracks the benchmark, every year the fund goes up by 1%, the benchmark goes up by 1%. Next year the benchmark goes down by 1%, the fund goes down by 1%. All we're doing in terms of tracking is perfectly meeting the benchmark number. Tracking error then measures the volatility of the fund return relative to the benchmark's returns. If we take a look at the spreadsheet analysis that we've looked at already, we can see the different rates of return, 2%, 4%, and so on. We'll come back to those numbers in just a minute, are the numbers that we saw on that spreadsheet. The tracking error is the standard deviation of the return differences. And then the information ratio essentially becomes the fund alpha, the negative alpha, minus 0.167, divided by the tracking error of 13.2%, or 0.13. Now let's just take a look at those numbers again on that spreadsheet. Here we see that the tracking error for the first line for year number 1, we have 7% for the security and 5% for the market. So if we take 7 minus 5% is equal to 2%. The next year, the next period, we have minus 10 minus 14. That means we have a tracking error of 4%. The next year, we have a tracking error of, well, you can see here, minus 8 minus 12 is equal to 20%. And the next year, it's 39 minus 25, 14%. So that was minus 20%, that's 14%. And the next year, it's minus, next year, it's minus 10%. Sorry, a little bit hard to read some of those numbers, but you get the idea. So if we were to create an extra column on the spreadsheet, we could calculate the tracking error. The sum of the squares of the differences, in other words, the standard deviation of the tracking error, is 13.2%. And so we saw that the the alpha was minus 0.167%, 1.67%, and the standard deviation of the tracking error was 13.2%. And that comes out to an information ratio of minus 0.13. Because the standard deviation is always positive, the information ratio always has the same sign as the alpha. In this case, our alpha was minus 0.167, so as a result, we expect to see our information ratio also being a negative number, a negative value. Okay, the calculation of it, perhaps a little bit more complicated than we'd like it to be, but the key thing to remember about the information ratio, essentially it standardizes the alpha for tracking error. It's alpha divided by our tracking error. Tracking error measures the volatility of the fund returns relative to our benchmark. And the information ratio also allows us to compare investments with different alphas and different types of tracking error. If two funds have the same alpha, we'd prefer the one with the highest information ratio. We've looked at quite a number of different performance metrics. It's important to remember, important to know, that we can end up with quite different results depending on how we use these particular ratios, these particular numbers. In a case like this where we've got some standard information, we've got portfolio A, B, and C. Those are competing portfolios run by different fund managers, and we're trying to decide which particular portfolio we like. We also have a market portfolio fully invested in all of the stocks in the market, provides us with a benchmark. And we've also got a kind of a risk-free portfolio, portfolio F. So these are our three different alternatives and two different types of benchmarks that are provided. Looking at the raw numbers, we can see that it looks like portfolio C has the highest rate of return at 20%. And then we've got portfolio B at 15%, and portfolio A is third at 12%. In fact, we kind of like C and B because they both give us a better rate of return than the market. Portfolio A, maybe not so much. Standard deviations are given in the next column over, so we can see 40% standard deviation for A and 30 for B and 22 for C. And we've also got a portfolio beta for each of these individual portfolios. Well, using that information and calculating the ratios exactly as we've seen it done in the previous pages, we can see the relative performance of the three different ratios that we're comparing, or three different measures that we're comparing here. So we have the Sharpe ratio, which certainly looks like that the best or the highest Sharpe ratio is going to be C, followed by B, and then followed by A. If we look at the Treynor ratio, the best number that we see here is going to be actually A, because it's giving us a 14% ratio. That's the highest one, and so that would be the one that we choose. And it's providing us, in fact, all of these are giving us better rate of return or better Treynor ratio than the market portfolio. And under Jensen's, actually, the best alpha that we get is from B, followed by A and C. And of course, with Jensen's alpha, where we're subtracting the market portfolio, the Jensen's alpha for a market portfolio would go to 0. So anyone that does better than 0 is producing positive alpha, so it's good. Yeah, you can see how this can get a little bit confusing. Which one should we choose? Well, we'd consider the purpose of the fund, the reason why we'd have different funds. The Sharpe ratio is most appropriate when we're evaluating an entire portfolio. It penalizes a portfolio for being undiversified. If you have a well-diversified portfolio, it would be very difficult for the fund risk to not be equal to the total market risk or the systemic risk. So any portfolio that is far away from being a standardized market portfolio is going to have the greatest amount of penalty. Treynor Ratio and Jensen's alpha are both appropriate for evaluation of securities for inclusion into an existing portfolio. So anytime we have a positive Treynor or a positive alpha, they would be suitable as providing additional return. The only difference between the two is that Treynor Ratio standardizes returns, including excess returns, relative to beta. The alpha is just a raw measure of the excess return. So both require a beta estimate, and we may find that the beta sources may actually be quite a bit different depending on how they're sourced, whether they use 24 months or 60 months worth of data, whether the data is weekly or monthly, and whether we make adjustments for things like lagged or leading information. Taking a look at the particular three portfolios we saw on the previous page, ranked best to worst, we've got very different results. And so if we are looking at an overall view of the portfolio and our concern is diversification, the best performer was C. The worst would be A. For Jensen, our best performer is B. And again, for Treynor, our best performer is A. I don't know if that completely clarifies portfolio performance measurement, but I hope it helps. In this session, we have taken a look at portfolio risk and return, global investment performance standards. We looked at a variety of different measures and how they're calculated. Of course, we probably want to do all of the calculations and compare them in order to understand which one's going to be best, but we have seen that there are different types of applications for different approaches. And information ratio, very good for calculating the performance of different fund managers who are tracking the same benchmark.